Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, joined by Chris Dearborn, Director on Nasdaq's Market Intelligence Desk, as well as Max Cabasso, Director on Nasdaq Market Intelligence Desk, Phil Mackintosh, our Chief Economist at Nasdaq, and Stefan Rust, CEO of Truflation. We're also going to bring in our Chief Technical Analyst, Brian Joyce. We're here to discuss market reaction to the Fed's recent rate decision, inflation, and the data behind earnings, the consumer, and more. Gentlemen, it's great to have you with us, and of course the news for the day is that the Fed left rates unchanged. Not too much of a surprise, not too much in terms of the language in the statement. Before we get into that, I want to talk about October for a moment here, as we just kicked off November 1st. In October, Phil, certainly played out as it historically does. We saw some volatility back in the market.
Yeah, but we had some really strong GDP numbers, and when you looked into what drove the GDP, it was the consumer, again, holding the economy up. So the consumer really is becoming the story of this year, and the reason that we're having the soft landing forecast and we've seen GDP in America so much stronger than in Europe, it's all about the consumer spending. Yeah,
and Stefan, what's so interesting is that we're over $1 trillion in consumer debt now too, but there's some things under the surface that you need to take a look at there.
Yeah, I mean, we're seeing, well, we saw the summer months, really revenge spending was what we call it, where people have been traveling. I think travel time, I mean, occupancy in the airlines is above pre-COVID highs for over 2 months consecutively. So we're seeing people out and about again, spending money, and they're using their credit cards to spend a lot of the time, which is very costly, but it's actually driving a lot of the economy and helping grow the market. Prices haven't gone. We've seen a shift from actually demand side or supply side inflation to now demand side inflation. Where in the past, during COVID, we had structural issues. We were trying to get all the supplies, fill the supermarkets, get enough oil. And now all of a sudden we've got the reverse, where actually there's enough supply and the demand is actually building a lot of the inflation and consumer spending. But we're also seeing government spending come into the play. We've got IRAs come in, TARP, so a lot of these different functions are beginning to sort of have its impact in a lot more the local side and a lot more infrastructural changes that are taking place.
And Chris and Max, let's bring the trading perspective into here, because as I mentioned before, October ushered in volatility. We're starting to think about seasonal now as we look into November and December. We'll get into that. What was your take on October trade?
You've got 3 months of declining markets, right? You've got the S&P, the Nasdaq 100, the Nasdaq Composite, and the Dow all down 3 consecutive months. Hasn't happened in a while. You know, you're looking at the major indexes, but then when you dig a little bit deeper under the hood, you're looking at the Russell 2000 down over 70%, the Russell Microcap approaching a negative 20% print for 3 months. You know, where's the money being put to work into the markets? And it's going to the larger cap names as opposed to the smaller cap names. You know, November seasonally very positive. If you look back historically, we'll see if that actually takes place. And if that does work, does that lead to a Santa Claus rally into the markets? Going back to Phil's point and Stefan's point, you're looking at consumer spend kind of pulling us through. You know, Ernst & Young has predicted that the holiday spend this year is going to be about $979 billion, which sounds like a lot, and it's a 3% bump from last year, but traditionally that's not a large increase. You know, post-COVID, you had over a 12% bump in that, and the year after last year was a nice bump up, but again, a little bit disappointing. How are people going to spend on that?
Well, you can also make the argument Prime Day is starting in July, and everyone else, you know, has a Prime Day now too. So it's, you know, the last 6 weeks of the year, hence the name Black Friday, when retailers get into the black for the year. I mean, you know, we've been buying holiday type pricing since July, Max.
Getting pulled forward. Everything seems to just be getting pulled forward. I know there's another, you know, coming up, like you said, Black Friday, but there was a Prime Day. It wasn't obviously as hyped up as the real, you know, Prime Day, but again, pulling forward some of that demand. Again, we were talking about the market. S&P, obviously down over 10% from the July highs, and even this month was down, but it's still outperforming the S&P equal weight. So again, where's all the money going? It seems to be going to the mega caps. Micro caps were by far the worst performer this month, down over 7%. I think 2000 was down just under 7%. So again, really funneling into, you know, those magnificent 7. A lot of the money heading into the large caps versus the small caps were really struggling, you know, as rates. You know, obviously the Fed didn't raise anything here, but they're still elevated compared to, you know, where we've been over the past few years.
Yeah, and we're going to get, you know, we're going to take a look at the 10-year and the S&P in just a moment here, but that really has been part of the movement that we saw in October as well. Just at the rate of speed the 10-year has been moving.
Yeah, it's closing the gap on the 2-year, which doesn't really make sense because the 2-year is still below the short-term rate. So the market's saying rates are going to come down in the next 2 years. Why is the 10-year catching up to the 2-year rate? I mean, in theory, the market's saying we're going to be at 5-ish% for longer, but You look at inflation coming down, you look at the demographics over the next 10 years, the workforce is going to age and shrink. There's a lot of slowdown coming in the economy, and I think the 10 year is a little bit too high right now.
Yield curve control. Are we going to follow the same footsteps that Japan has deployed, right? Are we going to try and replicate this yield curve control where we just manage the yield curve?
Yeah, I mean, in a way, Japan's been lucky because they've got higher debt to GDP than us, but they've been able to afford it because their interest rates have been so low.
Right?
The risk we're running is interest rates on the 10-year are going up just when we're expanding our debt, and so the interest payments alone are going to start to be a problem if we're not careful.
All right, let's bring in Brian Joyce. He is our Chief Technical Analyst on the Market Intelligence Desk here at Nasdaq. We're going to take a look at the technicals and what the charts are actually telling us is happening in real time. Brian, it's great to have you with us. Welcome back to Trade Talks. Let's pull up a couple charts here. We're going to take a look at the S&P 500 and certainly the 10-year as well.
Hey, Jill, thanks for having me. So right here, we're looking at a daily period look at the S&P 500. We could see the recent low made on Friday bottoms right at the 61 Fibonacci retracement. From the March low to the recent high in July. So that's a potential support level. And if I zoom out just a little bit further here, we could see that level coincides almost exactly with prior highs made back in September and back in the fourth quarter around December. So along with that, we do have some signs that the downward momentum is kind of slowing. It's abating a little bit here. So if we look here, this red histogram, this is the percentage of the members within the S&P 500 making new 26-week lows, 24-week lows. And we could see we've seen a recently bottomed on 21% in the last week, whereas earlier in October, it was down to 25%. So fewer companies making 6-month lows. And then the downward momentum as far as the measure of change in price, we can see that bottomed here at the 30 levels, an oversold reading. It was basically equal to where we bottomed back in October, in the early October in the first week. So we had a lower low in price, but we didn't see a lower low in downward momentum. So I think there's a couple of signs there for the S&P 500 that maybe it's been washed out. And then if we go into a longer term weekly period look, a lot of eyes for much of this year had been on that 4,200 level. It's really been a range between 41.15 and 42.22, and we fill that range this week. I should say last week with Friday's close, and now we're seeing a move higher here. So there's to me another longer term indicator that maybe the S&P has found some support here. We certainly have a lot to prove in the the weeks ahead, but we are entering November, which is typically seasonally the strongest month of the year.
All right, and Brian, if we can also pull up a 10-year for us for a quick review.
Sure. For the 10-year Treasury yield, you can see this is an intraday look. Today's trading session, the 10-year had moved lower on that quarterly funding announcement with a Treasury guided lower issuance for Q1 of next year, and the composition of that issuance is going to include a lot more Treasury bills than normally. I think about 60%. So that news essentially is saying is the expected supply of future issuance is going to be lower on the longer end of the curve. So we saw a move lower in yields, a move higher in price. On the daily period for the 10-year, you could see that on this recent move higher to 5.02%, we had a lower move in momentum. So that's one sign there that maybe the upward move in rates is overdone and needs some time to breathe. And then on the longer term look here, we could see that there's really just been a strong move higher since July. This breakout above last year's highs at 4.34%, that took place the day of last month's FOMC, and then we had a nice run up to 5.02%. So we've seen just recently on the weekly period as well a bearish divergence in upward momentum, and so I wouldn't be surprised here if we see one of the bigger pullbacks in the yield that we haven't seen in recent weeks. So I have a feeling, my gut instinct tells me based on the momentum readings and just the prior strong upward move in the yield, that we could be entering a longer period of consolidation, which I think would bode well for the equity market.
All right, Brian, appreciate the technical insight as always. We'll see you later this week on the desk. Back to the FOMC for a moment here. We know there was no change, right? We know there was really nothing new in the statement. Is the data that the Fed working with, is it real time? Is it up to speed? It feels like a lot of this is lagging and not really telling like the true day-to-day picture here.
And that's sort of why we set up Truflation.com, right, where we actually focus on aggregating some 18 million items versus the 80,000 items that the BLS aggregates from an inflation perspective. We do it daily versus once a month. It's immutable, so we can't go back and change it. We don't change the methodology. The methodology is fully disclosed and transparent, and that's how we try to do that. And we try to do that with 18 million items, 3 price feeds every single day, and bring that in a calculation. So we think actually inflation's at 2.4% today. So we're actually far lower in contrast to last year's number. However, if you aggregate that over the course of the last 3 years, we're looking at some 25% inflation. So people are walking away. If they'd kept their funds in US dollars alone, in cash, they would be walking away today with 25% less in terms of purchasing power, maybe income or tax, whatever, and however you'd like to call it. But you've got 25% less purchasing power today.
And Phil, we were talking about that perhaps inflation expectations, when you look at it on a year-over-year basis, they've just been reset. Right, you know, if nothing's moved over the year, it's technically 0%.
We were talking about food and the fact that prices have gone up and they've stayed there. But if they stay there long enough, it's zero inflation. You've started to see that now with cars. I mean, second-hand cars are actually getting cheaper. So there's definitely we've been in a high inflation period long enough now that some of the price rises are now starting to zero back out of the CPI number.
Yeah, let's talk about earnings for a moment here. I'm sorry.
Yeah, no, I was just going to add to that, right? I mean, I think people, when we see on our site a lot of comments coming back, why is inflation only 2.4%? It can't be 2.4%. And a lot of Twitter is very, you know, I mean, they're very vocal about the opinions on the numbers. And it's exactly the reason that you just mentioned. We stayed flat for so long that it hasn't actually moved that much, even though you're only feeling it actually when you get sticker shock today. But it's been the sticker shock that's been building up. And you've only just come to the realization of that now.
Right, and that's a great segue into earnings, Chris, and I know you're going to bring this one up.
Yep.
Consumers are going to have to start to think about, and we'll see this when you start to get the earnings in the next couple of weeks, certainly in your group.
Right.
Where are they spending? Discretionary? Probably not. Staples, discounters?
Staples have been pretty consistent. You've got about 60% of the S&P 500 is already reported. Max can go into this a little bit more, but what you're looking at is a beat, which is better than what they thought, but it's not close to where we've been. It's really underperforming at what, 5%? Yep. And that's really underperforming a one-year expectation. The consumer names are going to be coming out there. A few of them have. If you want to, again, as I said before, dig a little bit under the hood. If you look at the S&P 500 Consumer Discretionary Index, it's down over 12%. And if you look at how it's reacted over the last 3 months, there's only a handful of names that are actually have a positive return for that 3 months. Some of the larger e-commerce companies, as well as some of the athlete companies as well. But if you look at some of the other names, they're significantly underperforming, down double digits percent, 10, 20, 30%, and they had beats in earnings. So the punishment is actually worse to companies, not on what they've done, but what they're forecasting to do. And that comes into the consumer spend, with GDP being 2/3 consumer spend, and the black coming in on day after Thanksgiving here. Is that money going to come from? It's not coming from savings. We see a decline there. They're definitely spending more. Where's it going to come from?
Credit cards.
Credit cards, right?
As we're talking about, before we started here, credit card debt, on a nominal levels is over $1 trillion. Now, again, inflation adjusted as much, but rates are well above where they've been over the pre-Great Financial Crisis. I think it was over 21% now is the average rate on credit card debt. Historically, it was closer to 14. So obviously, it's a 50% gain in what you're paying on that interest. And again, back to earnings. The beats, you've done well, they're getting punished. If you're missing, you're really getting punished, and beats you're not getting rewarded.
We saw that in tech.
Tech, especially. Now you've seen hardware's actually perform better than software. Some of the semiconductor names, anybody that's kind of exposed to autos, have been really getting punished this quarter. Materials and utilities, the only two sectors on a net basis that have had positive results in terms of the stock appreciation over the 2 days following an earnings print. Every other sector has had, you've been getting hit, essentially. So those are the only two sectors, and they're essentially flat. Materials, average price moved about 20 basis points, and utilities is 11 basis points. Everybody else is negative over a 2-day period following earnings. So again, even if you're beating, you're not getting rewarded, and if you're missing, you're really getting hammered for it. So it's not a great environment right now there.
Yeah, what's your view?
I feel better about earnings. I mean, we're coming out of an earnings recession that's been going on for 3 quarters now, and we thought we might have another quarter of negative earnings, but it has turned positive. So the momentum for earnings is good, and part of the reason for that is the margin compression that the higher wages was causing starting to wash out, and companies' revenues have been growing anyway, now their earnings per share, so their profits are back on track and following the sales numbers up as well.
All right, Stefan, last word here.
I feel, sort of contrary to what a lot of people believe, crypto has actually diverged as a new asset class, right? It's diverged from stocks, and it's actually had Uptober, right? So it's seen a boom in the month of October, and it's looking like a Movember, right? So it's going to move along in the same trajectory across November. That's sort of the sentiment there, which I think is actually an interesting asset class. And I think BlackRock, these ETFs, the change in tone associated with Gary Gensler and the SEC around all of a sudden we will and are looking to actually maybe approve these ETFs when they approve it. I think, but those momentum shifts are actually driving a lot of liquidity into the crypto asset class. And I think that's an interesting area to play. And we'll see something happening.
Especially as investors are looking for alternative asset classes and moving away from 60-40s. So I would agree with you there. All right, gentlemen, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.